People think inflation is CPI. The defect in fiat currencies is monetary inflation. It's the expansion in the money supply, not just the increase in consumer goods, because the CPI is it's a sub-metric, right? If you look at the US dollar, the supply of dollars has been increasing 7% a year for 90 years. It's been increasing 15 to 20% a year for the past 2 years.
Whoa.
Right? Right. So the big idea.
I think that's true. So it seems worth walk us through where do you get that number?
Well, if you go back to 1930, my house in Miami Beach cost $100,000. And if you roll the clock forward to 2012, it cost $14 million. And today it would cost you $40 million. So it's 400 times more expensive, a scarce, desirable asset, something that is you can't make any more of. You'll find typically the increase in cost about 7% a year normally. You can actually see, if you look at the market basket of things people want, like really good healthcare, really good education, a beach house in the Hamptons, artwork, Picasso's, right? If you look at the price of a basket of stocks, like the S&P has gone up about 10% a year. Well, the reason it's gone up 10% a year is because the money supply expanded at 7% a year, and then the underlying companies probably grew 2 or 3%, effectively. So you can figure this out for yourself if you just start to go and take samples of what stuff cost in 1971, what it cost in 1930, what it cost in the year 1950. And what you'll see is that for anything that's really desirable, like scarce energy that has energy content, it doesn't go up in price 2%. Now, the stuff that doesn't go up in price as expensive is stuff that's highly manufactured with low on the gold standard. Theoretically, during the gold age, 1870 to 1914, if a dollar was convertible into 20th ounce of gold, right, and you really pegged it hard to gold, then you're anchoring the currency into a hard asset. Now, gold isn't fixed in supply. The gold supply increases at 2% a year. 2 to 3% a year. So if you're on the gold standard, that means that the supply of money would be increasing at 2% a year, or otherwise doubling every 35 years. So money under the gold standard, perfectly executed, bleeds energy every 35 years. It's got a half-life of 35 years. But that creates stable prices, Tom, because the economy grows at 2 to 3% a year. So if the economy grows 3% a year, if the money loses 3% of its value a year, then everything kind of stays stable, right? The demand increases, the supply increases, right? That's a good situation. In that case, you can save your money, and 30 years from now, your money will be worth as much as it is today. Now, if it turns out that you're saving your money and the supply of money is increasing at 7% a year, then the money is cut in half every 10 years, right? And so that means in 30 years, the amount of money you have will be cut in half once, twice, 3 times. So under the fiat standard, the money supply is expanding from 7 to 14% a year, depending on where you are, until we got to COVID. And in COVID, everything doubled. And so you started seeing a much more rapid collapse in the value of fiat currency. The US dollar expanded the money supply 15 to 20% a year. And so in the US, we expanded the money supply maybe 40%. And so US single family homes went up in price 40%.
Oh, God.
I think about the correlation. The price of a house is 40% higher than it was 24 months ago. The amount of money in dollars is 40% higher than 24 months ago. The number of houses are about the same. The number of people who want them about the same. Makes sense. Now, if you go to other countries, if you look at currencies outside the US in the past 12 months, right? The Chinese currency has weakened 7%, Australian's down 8%, The euro's down 15%, the won's down 15%, the pound's down 17%, South African rand's down 18%, Polish zlotys down 18%, and Japanese yen's down 24% in dollar terms. What's happening? They're printing more money, right? It's even a bigger issue for them. The Japanese central bank is printing infinite yen in order to buy every bond and keep the price of bonds much, much higher than they would otherwise be. So they're holding up the price of bonds by pumping yen in the economy. And the reason, as they do that, the yen crashes against the dollar. But of course, it's even crashing faster against scarce desirable assets. The US has the world's reserve currency. So if you think about the way the economy worked 24 months ago, the countries like countries like Russia and the like export $1 trillion worth of raw materials, like energy and metals and the like. And then countries like China export $1 trillion worth of products and services. And we pay for them by sending back $2 trillion worth of dollars. So what we do is we export $2 trillion worth of inflation, and they export $2 trillion worth of products and services and energy, because we run the banking system of the world, right? The banking network plus the US dollar is the world reserve currency.
Really fast, I need to ask because I don't understand. So when we send them the $2 trillion, we are creating that money in order to make those purchases?
Yeah.
So we're not just taking money that we've already saved.
Let's say there's $50 trillion circulating around the world, and we just print 2 trillion more. Now there's 52 trillion. We've inflated the currency supply by 4%. We've devalued everything by 4. And we've traded $2 trillion worth of US dollars for $2 trillion worth of coal or products or iPhones or labor or something, right? And that's the way it works, right? And the reason it works, though, what is the real export the US provides? Financial economic security. If I'm increasing the supply of dollars by 7% a year, and if you're holding $100 billion of my debt, then you're paying $7 billion a year to hold the debt.